Good day, to be loved from the Accounting Club once again, where we enable you and your business to succeed. On this guide, I want to talk about how to take money out from your business. This applies more to limited companies. All right. All right. So, as a limited company, the company is separate to you as an individual. It is a separate entity on its own. You cannot simply take money out of a limited company like you would on a personal account. And that's because all the funds belong to the company. Yes, we know you are the director, you run the business, you generate the funds, but the funds belong to the company and not to yourself as an individual. All right, so how then do you then take money out from your limited company? Method one, via salary. This is where you pay yourself a salary. Number two, through dividends. Number three, through expenses. This is where you reimburse yourself expenses for things you have paid for on behalf of the business, or you pay for things directly using the business account, and that reduces your need for cash. So I'm just going to go a bit more detail into each one. So let's look at salary. So you pay yourself a salary from business. A salary is taxable, but as a director of a limited company, you want to consider paying yourself a minimum salary, which is tax-free, and the tax-free salary is 12,570. So when we say tax-free, we mean it is free of income tax. So we have income tax, you have national insurance, and so this is the amount that is free of income tax at this present time, and that is equivalent to just about £1,000, just over £1,000 per month. Um, to draw a salary, you would need to be registered as an employer. Now, if you're drawing a salary below £5,000 per annum, you may not have to register as an employer. But if you're taking a salary above £5,000, you will need to register as an employer because national insurance is payable on salaries above £5,000 per annum. You, if your business can afford it, you can pay above the tax-free allowance, 12,570. But I would not recommend that as a director. Okay, if you want to take more earnings from the company, I recommend that that is done by way of dividends. And this is where your company has enough profits. Now, if your company does not have sufficient profits, then you may want to consider taking a bit more in salary, but that means you will pay more tax. By taking the tax-free allowance as salary, you minimize your exposure to pay e-tax as a director. If you're taking a salary, the recommendation is for you to pay this monthly to yourself from your business account into your personal account. Dividends. Dividends are distributions from profit. Okay, so your company has traded, you have profit of say £20,000 after tax, then the whole of that £20,000 can be taken out as dividends. Your company must be profitable to draw dividends. If your company has made a loss, then you cannot take dividends, and any dividend taken with a loss-making company will be deemed as illegal dividends. Your company must account for corporation tax before dividends. All right, so you don't need to have paid corporation tax before you take dividends, but you need to account for it. You need to provide for it. So as an example now, if your company sales were example um, turnover was probably maybe let's say £40,000, and then your expenses were maybe all business expenses were £15,000. That leaves you a profit before tax of £25,000. Now you need to account for tax on that £25,000. Okay, so let's say the corporation tax rate is 19%. So 19% on 25,000 is 4,750. All right. So the profit after tax is going to be 20,250. You can only take dividends on 20,250. Okay. That's what I mean by the company must account for corporation tax. All right. So to take dividends, you need to have like a management account or a forecast as a guide to know that your business is going to make some profit. Dividends are not a tax deductible expense. All right, so um, you cannot deduct dividends from your business as business expenses. Okay, um, it's not they are not tax deductible. You cannot deduct dividends as a business expense. Dividends can be taken at any time. They can be drawn at any time in the year. You don't have to wait till after your financial year end. So you can take it monthly by monthly, every quarter, and then you can then top it up um, at the end of the financial year when you're certain of all your financial figures and what you have on your balance sheet. Um, Dividends um, have a low rate of tax up to a certain threshold. All right, so um, if your income, if you take the 12,570 salary and then you take dividends of, and then you take dividends to make up your to make up to £50,000, that will be taxed at 8.75. All right, so let's say your target is £50,000 for income from a company, of which 12,570 you've taken as salary. You're not left with 37,430. That £37,000, if you take that as dividends, is going to be taxed at 8.75%. Anything above that will be taxed at a higher rate. So you just want to bear that in mind. Whilst you pay low tax on dividends, anything above um, dividends where your income is already at 50K and above, dividends above that will trigger a higher tax rate. Um, Expenses, the third way you can take money out. So pay for all business expenses from the business. What that does, it reduces the need for cash. All right. So if you pay for everything from the business account, it reduces your need for more cash. So the cash you only need will be your salary and dividends, right? Um, and it just helps you to manage your self really. Expenses must be only and exclusively relevant to your trade. So the expenses must be truly business expenses. It has to relate to your business. So you want to try and associate your um, expenses to business. And what do I mean by that? Just as an example, if you're running a business, you need a laptop, you need a phone. So if you need to buy a new laptop, don't just buy a laptop for yourself as a person. Buy it as a laptop that you use for the business. All right. So make it a business expense. So quite a few things are obvious as business expenses. Some are not. A suit, as an example, is not a business expense. All right. Um, a uniform that has a complaint help emblem or logo, that is a business expense. So you always want to make sure you have a clear understanding of what is and what is not a business expense. There's no limit to what you could incur in business expenses as long as they relate only to the business, as long as they relate only and exclusively to what you do as a business. You can claim for, you can reimburse yourself for out of pocket expenses. So if you forget to, if your business does not have enough funds, as an example, and you use your personal funds, or you forget, or you involuntarily used your own personal funds for the business, you can reclaim that cost from the business. All right, the business can reimburse that to you as an expense. It is illegal. Let's remind ourselves here that it is a legal requirement to maintain receipts and records for up to 6 years. I hope you have found this useful. If you have any questions or require further clarifications, do feel free to reach out and we'll be happy to help. Once again, Toby Lab from the Accounting Club, where we enable you and your business to succeed.